So today I want to talk about some of the biggest stock market losses in the entire history of the stock market. I want to hopefully try to get a look at some international markets as well. But the goal here is to basically try to understand the downturns. And by understanding them, you can start to figure out when things might get better. So there's a lot of ways to look at this, but one way, if you're just wanting to focus on data, if you notice these red down arrows basically get more and more aggressive, right? So this first down arrow is around 2001, the second one is around 2008, and the last one is most recently around 2020 or 2019. So I don't know if I can really trust this graph too much, but it does give you some idea of this concept of inflation. So you can kind of see if you adjust like for example, you buy a candy bar today versus buy it 10 years ago, might have been 50 cents, but now it's like $1 or even $2. So that's inflation. So the price of the S&P, you might have to divide by 3, just to get the real price. So this is a picture of what the first big crash looked like. So there's quite a number of interesting things about this. First of all, you can see that the data really didn't start for the S&P 500 until about 1928, right? And at that time, the stock market basically kept going up for quite a long time, right? About 2 years or so, and then in 1929, that was when basically the first crash happened. So this was the first major crash, right? And you can see this is the interval per week, but at least it gives us some visibility. So if you look at the data here from essentially 2030 to 2032, halfway through 2032, essentially it took about 2.5 years to hit the bottom, right? So that's quite a long time. It's more than 2 years, it's 2.5 years, right? So a whole 1 year of everything going down, a whole another year, and then about a half year after that. And then finally started to recover, and then even after recovering, it dropped a little bit again, and so on. But essentially, that's the story of the early 1929 crash. So I wanted to just add a little something extra here to kind of hopefully not add to the complexity, but simplify things. So there's something called the price to earnings ratio. That's been tracked pretty carefully all the way back to about 1880s. So you can kind of see that this first crash, where it kind of shows around 1930, but 1929, what happened is that, you had the price to earnings ratio went up a lot. So it kind of skyrocketed. So what that means is that the price of the stocks keep going up, but the earnings aren't necessarily tracking with it, right? So immediately after that Black Tuesday in 1929, price to earnings ratio went down, meaning that the price of the stocks were going down, and it was getting closer to the amount of earnings that the companies were making. So that happened, like we said, for at least 2.5 years, and then things started to get worse again, you could say, right? Out to like 1940s and so on. So again, things keep climbing up, the price keeps going up, and then you get a crash. So that's one way to kind of understand this. So that's kind of the technical truth of the recovery. However, the other way to look at it, if you're kind of looking at the pessimistic side, because there was a lot of, when did it actually make it back to the original levels of S&P value, right? So essentially, it took all the way until about 1955, right? So that's about 20 years. That's a significant amount of time in terms of, having to go all the way down and then all the way up, from 1950 so from the 1929 crash. So, there is kind of debatable, exactly where the start may have been. One other kind of like halfway point is kind of 1942 here, which I show around April, right? So you can kind of see that there was, before that, the stock market went up and went down. There was a lot of kind of, actually people were pretty optimistic. 2 years after that, they kind of started to buy quite a lot, right? But then it kind of became a little bit more stable after 1937, and so on. So maybe realistically 10 years, a little bit more than 10 years, for that to kind of recover. So the interesting part about this time period, the mid 1950s, is that this was the start of essentially nuclear power, right? So actually, Russia created the world's first nuclear power plant. So this was kind of the big era of essentially the Soviet Union, and it also was a very important time because it was after World War II, and essentially, big prosperity would suddenly start to happen with both nuclear power and industrialization. So what's unbelievable about this whole story, the purple line there is that same quartile rank that I was showing. So if you look at this, this is essentially the stock market up until like modern times and the most recent crash in 2020. But essentially, that's the story of about one third or one fourth of the whole history of the stock market. That's from essentially 1928 all the way up into 1955, right? That's the purple line there. And then the rest is what we're looking at kind of after 1955, which is that kind of the yellow line average there, and then the actual stock ticker being the purple one. So this next era is super, super important. I think a lot of people don't study this area, essentially because it's a little bit tougher to understand, but essentially it's the first era after that initial 1929 crash, right? So you start to see a significant upward trend, from essentially, September 9 of 1954 to to basically the top at 1973, right? So, and then kind of a sudden drop there again. But essentially, this is the kind of first time where, in the 1955s, you kind of have nuclear power plus industrialization all the way up to essentially 1973 or so, right? And that kind of was a pretty positive era, but there was some significant downturns within that. So that time frame, this first part, all the way up to about 1974, is basically half of the total time frame of you know the stock market here. So here is kind of the first part of the modern era of the stock market, and this is basically up into about the eighth or ninth month of 2000, um, and it's really called the 2001 crash. But it really started, the very very top was around September of 2000. So and that started essentially back in 1974 or so, right? So this is the modern era of the stock market, and it's kind of the first major bubble, extreme bubble, like, kind of redefining a lot of things about the stock market. So this is kind of, excluding the 1970s, the perspective of what you might think of as the stock market data, right? But actually, I think it's important to look at that first 1974 to 2001 era and kind of consider that as one continuous era to study. So, great. Now we have kind of the main eras of the entire stock market history, right? You have 1954, 1974, you have 2000, and then you have the 2007 peak, and then the most recent 2019 peak, right? And these are kind of the eras of how the stock market, changed, and so on. So I want to be a little bit careful here because the peak there was actually in 12 of 1972, right? There was a bottom at that other point. So uh, we have to be careful because we want to look from the bottom of one point to the peak of the next, right? So it depends on how you look at that. So in some senses, we basically have two halves of this modern era of the stock market, right? You could say three, but I will explain that in more detail in a moment. But so essentially, we have kind of the 1972 to 2000 era, which is kind of the start of the technology era, right? And then after 2000, 2001, that crash from and that this is the second half of the modern era. So right now what we're in is essentially kind of the second or even third part if you consider this dark blue line, right? That crash basically in around 2007. So we're going to look at that kind of together because the 2000 era was so important as well as the 2007 thing. So in terms of understanding these crashes, right? So these are crashes that we have quite a lot of data about, and also we know quite a lot because we were living through a lot of these time periods, and we know, essentially, with the dot-com crash and the housing market crash, right? And then the most recent crash. So we want to look at this in more detail here. So, you may hear a lot about this so-called 1987 crash. So I wanted to kind of highlight that as a starting point. You can see that that was actually it's a very important kind of technical point in the data. So while it was a crash, it's nothing like what we're seeing nowadays since 2000 and 2007, and especially since 2019. So in general, we want to just use that as a very, very specific data point in terms of how we look at the rest of these points. So, unbelievably, that point back in 1987, which you can see on the graph, looks like a very minuscule kind of loss. But the thing was is that the S&P, 500 and the Dow, it wasn't that high, right, relative to today's levels. So losing a little bit, what seems like a little bit back then, was actually a very big percentage of the market. In fact, it was about a 20% loss in one day. And to this day, that remains the highest single day loss ever. So that's an important kind of reference point in terms of percentage loss, right? But if you kind of look at what's been happening recently, we have about a similar loss in this 2019-2020 crash. So, it's interesting because what you see in the fine print here is that that may have actually been the first real computerized crash in the stock market. Back then, that was kind of the 80s into 90s was when computers really started to get used pretty heavily, even in the stock market, and even personal computers started to become possible. So here's kind of a graph showing all the various kinds of crashes, and I took kind of over just a short period of days, right? So this 2020 crash essentially is as bad as the 1987 crash, which, remember, the 1987 crash was perhaps mainly due to computers, right? The 2008 crash relative to the other crashes here you can kind of see, and then the 1929 crash, right? But you can also see there's some other ones that you may not have heard about in terms of very significant losses over just a day even. So, those are a lot of crashes, but let's look at this basically second half of the stock market, right? So this second half of the stock market is divided up into these two subsections, right? So we basically have around 2000 a peak, a 2007 peak, and then this 2019 peak, right? And you can kind of see that this first kind of part it was kind of up and then up again and then down again, right? So the thing that we pointed out earlier here is that each of these crashes, if you do the uh, kind of the trend line here, you'll notice just even on a straight line, you'll also see that the crash in 2000 was slower than the crash in 2007, and then this 2019 crash has been extremely fast. So I kind of drew some lines so you can see what we're talking about here, right? So this drop um, in 2001 was fast. The next red arrow was it's even sharper down, and then the third is almost straight down, right? Now you can also see that the green arrows, it took this second green arrow had a longer period, so although it was faster down, it had a longer period of up. Now the question is, don't necessarily extrapolate this, but it's very interesting to see that these downs seem to be very quick. Maybe that's in part due to algorithmic trading. So we don't really know because of that in terms of how the algorithms might, correct or not correct. So what I drew in here was the two kind of final lows. So kind of giving you a time frame between, say, the 2000 and 2002 recovery and the 2007 height and 2009 final low, and then recovery after that. So what we see here, the distance between that blue line and the orange line on the left is more than on the right, and so on. So it could be that the time till the lowest low is actually becoming less now. So in some ways, what that means is that people kind of know what the stocks are worth more. However, when you look at the wide range of things all the way back to 1929, what you realize is that stocks in general have been extremely low. So, who really knows? But, it does give you some ideas here, at least from the data. So, this is an interesting part of history, right? So, this is basically just after the end of the 1987 crash, then all the way up to 2000 and 2001, right? So you can kind of see, there was actually some interesting stability upwards in after 1987, and then kind of a lot of volatility, and then that first green line there is kind of that, it looks like people were trying to figure out what a steady rate up was. So that is very questionable whether or not we can extrapolate that all the way to 2020. But this was kind of the first time that the market looked at like a new upward trend. So we're kind of dividing up the entire history of everything in the stock market into two major sections. This is kind of the right half, and the left half is all the way, essentially up until about 1974. So what we're looking at here is essentially the new era, right? I'm calling this first half up until about 2007 and 2009 the epoch of HFT, or high frequency trading. And this is kind of the first time where real algorithms at higher speeds, megahertz plus, started to get into the trading world. So I wanted to kind of separate that because I think there was a lot of testing going on after this crash in 2000, 2001. There wasn't it wasn't like really mainstream, and so this next era here is kind of the first real era of algorithmic arbitrage. So this still includes HFT, high frequency trading, and general, computers and algorithmic trading. But it's something slightly different. It's more something called arbitrage, right? So there's a lot more involved in like cross-checking between, multiple data sources. Where maybe the first era, and even back into the 80s, was, more statistical or just looking at, the numbers. Still probably looking at many other factors, but not as fast and as real time, not involving HFT plus algorithms plus everything that we currently know. Now, the interesting thing I realized about all this is that after this era, most of these algorithmic trading kind of companies are kind of done at the big time. It's likely that after this crash, we may see a recovery and a new kind of era of kind of personal or like regular Joe, regular people out there having their own kind of algorithmic trading and even arbitrage, high frequency trading, pretty advanced algorithms just going to the common person. So we're not quite there yet. People are starting to develop these kind of things, these tools on their own. But you can see that, back in 1987, there was a crash because of the computer situation. It's likely that there's going to be a crash for that as well. So you know, but in general, we're kind of seeing that we know that something like 70, I've even heard 80 or 90% of all the trades at some points are done by algorithms now. So you can see that in the volume, even in this chart around 2000, right, to 2007. And then after 2007 to 2020, it basically doubles the volume, right? So that's maybe half of that. Let's say even 75% of this is probably due to just computers trading, right? We don't have, obviously, there's not a double in the population between 2000 and 2020, but the trading volume has almost doubled. So there's a lot of things in this detailed graph, but I kind of wanted to break it into two halves here to just hopefully simplify things. So it's not to say that there wasn't a lot of algorithms being used before, say, 2000. Actually, we could probably say that around 1994, perhaps you can see. We really have to look at the volume here. So it's maybe around late 90s. You can kind of see that the volume is increasing significantly. So around that time, you can probably say that that's kind of the start of most of this trading, right? But in terms of really fast, high frequency trading, you can see that kind of started somewhere between 2007 and 2009. So although, a lot of people say that was a housing crash, from a trading standpoint, we're starting to see a lot more volume all the way through 2000 to 2009. So here's kind of a zoom in of this first era of high frequency trading, right? So this is kind of in between that, after the crash of 2000 and then looking all the way to 2007. So you can see at the bottom there around 2002, the orange line, things were kind of confusing, even all the way up into, after 2003. So by 2004, things were going crazy, and then they kind of settled down again through 2005 and so on. So this is all a huge area of study. All these sub intervals, kind of understanding the psychology and just what was going on, right? So even before 2007, you can see there was kind of a pre-drop there. There's just so many details here to kind of look at. And even in 2009, it looked like there was a multiple bottoms, right? So it's just hard to say, where, how bad things were, or what was. Yeah. So when you look at kind of that 2000 to 2009 time frame, that was actually pretty complex. There was a lot of like sub intervals and kind of questions about what was going on. So really, 2000 up until 2000 was a lot. That whole market from 1994 and even before, right back to 1987, and so that was kind of that changed everything because things were just going up wildly, right? So these were the first major downturns in the market. So there's a lot of computer kind of studies of this, but the interesting thing is that we know that after 2000, yes, there was a lot of algorithmic trading. It started with like just 20%, 30, 40, so on, going up to today's about 70 or so percent. But now we kind of changed everything after 2009, right? So this era is kind of like the final question of like what was going on. Um, things started to stabilize again for quite a number of years. So it's actually been about a decade of upward trends. But there has been certain about 3 or 4 points in there that you can kind of really see that there was some major downturns for significant numbers of months. So here's kind of some more details of the algorithmic arbitrage era. But looking back at everything, you can kind of see essentially how we've laid out the entire history of the entire stock market, right? So you basically have that first part, right, which is basically the 29 to 19 53, 55 era, and then you have that all the way going up to about 1972, 74, and then you have kind of this high frequency first computer era all the way up to 2001. And then you have this, high frequency algorithmic trading arbitrage era, which is the current all the way from, essentially 2008 to 2020. So I just had to kind of change the interval here to double check on some things, but you can kind of see the actual details here a little bit better. I just wanted to check on the exact high points. So at least for that 1929, 1954, 1972, that kind of whole frame, those are correct. It's harder to read this more recent time frames because the volume has been increasing a lot. So there's a lot of new changes in there. So I just wanted to conclude this whole discussion with general thoughts on economic crisis and crashes, and just kind of go through all the major ones here really quickly. So it's interesting because ever since like the 2000s to 2010 and 2020, there's essentially just been a lot more financial crises. So one way to look at this is to look at country debt. So we've been looking a lot about particular companies, S&P 500, but really what this comes down to in terms of what's going on is what's going on with the global debt, right? So in some ways, we still have a long way to go in terms of getting rid of or kind of changing the way debt is done. So, there's some unbelievable numbers here. This is sorted by countries with the most debt. So, the most debt by far, the next nearest debt, is like 1/20th of that debt. But still, United Kingdom has a lot of debt, right? So, we're talking about almost $1 trillion worth of debt for the United Kingdom. However, this is like 20 trillion for the United States, right? So, and then 568, so billion for France, Germany, so on, Netherlands, and then Japan. So on the right here, you see the debt per capita. So that's not always the same. So you can see that the debt per person in the United Kingdom is a lot more. So in some ways, if you sort this by debt per person, that's a very interesting another way to look at this. Or also looking at it as the percentage of the total GDP, right? So, and even there, you can see United Kingdom looks 3 times worse. So, there's a lot of ways to look at this, in terms of debt. And the other way to look at this is kind of see gross public debt as a percentage of GDP. These numbers are a little bit different. So here you see Japan and Greece and Lebanon and Italy, so having a lot of public debt. So the other way to look at this is per person or per capita, right? So even Norway shows up on this, right? So I've heard Norway has a surplus, but here it's showing public debt even. So, and then there's unbelievably projected debt. So you can kind of see what's been happening in the past, and then recent year, and then kind of the future, right? So you can see, places like Venezuela having a huge gross government debt. So there's also something called household debt. And here you can see Switzerland shows up as number one as a percentage of GDP. So that means the average household has a lot of debt. So the interesting thing about this number, this includes all mortgage loans, all consumer debt, including credit cards. It also includes student loans and car loans. So here, what you see essentially is that most of these quote unquote wealthier countries have household debt more than quite a number of them have almost equal to their whole GDP. So there are many ways to try to understand what's going on with the economy. The other great way, it's hard to get all the data, but they're starting to become, Harvard has a great import and export trade balance database. But here's kind of an overall map. You can see the green countries have a positive, exporting more than they're importing. So their account balance is positive, and the dark red have the most amount of imports. Now you can also look at that same data in terms of per person or per capita. So one general thing is this idea of inflation. So you can see that it varies greatly, right? So in countries that are having recent problems with their financial system, the price of goods goes up. Food, for example. So you can see here like Venezuela in Eastern Africa, and then also in places in the Middle East. So that can change, dramatically from year to year. But in general, you can kind of see that prices, will go up if everyone's not making that much money. This is just a very important graph to kind of give you an idea over the years. So the part that I thought was very interesting about this is that inflation can be almost 10% per year, meaning you buy something for $1, the next year it's $1.10, but it looks like typically it's hovering around 2.5% or even 5%, depending how much you trust the data. But in general, this gives you kind of some ideas of the fluctuations. So that's why it's kind of hard to tell sometimes, like when you still buy something, for $1, is it really $1.10 next year or $1.05? But over the years, 10 years, all of a sudden you get, more than just a 100% increase because it's compiled annually. So here's kind of the simplest possible map I could find to explain inflation, right? So on the left axis you have 100, and then on the x-axis you have the years. So what you see is like $100 in 2010. If you had just $20 bill in 1955, that could buy you essentially what a $100 bill could buy you, or $120 could buy you today. So in general, you can see that the numbers vary wildly on either side, but it's maybe a topic for a separate discussion. Anyway, I hope you enjoyed everything. So everyone, I hope you really enjoyed this study. There's a lot of details here involved. Hopefully made it a little bit more simpler. What I would say is that studying the S&P 500 and all the other components is just one aspect of everything. I'd also recommend just looking at, like I did at the end of this presentation, on trade, import and exports, and just general debt and financial situation of every country. Sometimes you might find yourself way ahead simply by understanding how the world works rather than just one part of the economy.